Do the narrow corporate bond spreads impact the way you invest in fixed income?
Well, let me provide you an update on a bond actually that we talked about in last quarter's outlook, which is the AerCap bond. So in the last quarter, we talked about buying the AerCap bond in October of last year and how attractive it was. Well, it actually got too attractive, and now we ended up actually selling the bond. As we can see by this chart, since October, the bond went from par, basically 100, to 107. So in a very short period of time, it went up 7%, and the yield actually declined to a level of 4.16%. So when we looked at the environment, and with corporate spreads declining dramatically, as we can see by this chart, we felt that it was opportunistic to take advantage of declining credit spreads and also an investor's insatiable appetite for yield. So we end up selling the AerCap bond, where we take advantage of both the market perception that interest rates will remain low for a very long time. We take advantage of the fact that, again, investors are consistently searching for yield, and also taking advantage of very, very tight credit spreads. So what did we do with the money? So we ended up buying an AerCap floating rate bond, which actually has a higher yield than the fixed rate bond that we sold. So the fixed rate bond we sold had a yield to call of 4.16. The floating rate bond we just purchased has a yield of 4.81. The other thing that we did was we sold the AerCap bond, as I mentioned, at 107, and we bought this floating rate bond at 80.5. So that's $26.75 that we're taking out of the bond and having a healthy capital gain. And finally, we de-risked the portfolio by eliminating the interest rate risk and the optionality of higher rates in the future. So this is just one of the ways that we're trying to find value in a challenging fixed income environment.